This morning, U.S. Treasury yields surged across the curve, hitting multi-year highs. The yield on the 10-year U.S. Treasury note climbed above 4.65%, marking a fresh recent peak, while the 30-year Treasury yield briefly touched 5.2%, the highest level since 2007. At the same time, the U.S. dollar index strengthened as large amounts of capital flowed into safe haven assets. Institutional analysts believe the sharp rise in Treasury yields is forcing markets to reprice expectations for future Federal Reserve rate hikes. Combined with stronger than expected U.S. economic data, this has triggered a new wave of global asset reallocation and further increased the possibility of the Fed resuming its tightening cycle. Meanwhile, the continued expansion of the U.S. fiscal deficit means the government will need to issue even more Treasury debt. If Treasury yields continue to surge, markets may begin redefining the direction of risk investments. Previously, with risk-free yields around 4%, investors were more inclined to allocate capital toward higher return assets, such as gold. However, if risk-free Treasury yields remain above 5% for an extended period, capital could increasingly shift toward the safety of U.S. government bonds instead. According to CME data, markets are now betting that the Federal Reserve could resume raising interest rates as early as January 2027, with the probability of another hike within the year approaching 60%. A prolonged high interest rate environment also significantly the opportunity cost of holding non-yielding assets like gold.